giving our feedback for the North Star Global Flexible Fund domiciled in Ireland, a dollar-based fund for the year ending 2022. It was really a terrible year for investors on global markets last year, as all asset classes performed quite awfully. The all-country world index was down almost 18% in dollar terms. Global bonds down about 16%. The fund's benchmark was down almost 17%, whereas the fund lost 14% for the year. Certainly not great to give a negative return to investors, but a significant outperformance relative to the benchmark of almost 3% in 2022. So what did we do right? Well, we were underweight bonds. The benchmark is 40%. Our fund was just above 12%. And considering the horrific performance of global bonds last year, this was a really good call from our bond team. We also held quite a bit of gold, about 8% of the fund, and that had a flat year versus equities, which, as we mentioned earlier, were down almost 18%. From a sector-specific standpoint, we made some really good sector calls. We were underweight technology, which was down over 30% last year in dollar terms. We also underweight consumer discretionary, down almost 34% on global markets. We overweight staples, which had a negative year, but just over 5% down, but certainly much better than the market. And we also overweight healthcare, which lost about 5% for the year. Then, of course, the major issue which drove our performance was stock selection once again, adding over 4% of alpha in 2022 in the fund. What did we get wrong? Well, quite frankly, we were quite negative on global equities in end of 2021, very worried about valuations. And the fund had about a 68% exposure to equities through the year. This probably could have been a bit lower. So I'd say the one thing we really did get wrong is not aggressive enough in cutting that equity exposure. My concluding remarks really in terms of a score for the year, somewhere between 7 and 8 out of 10. We beat our benchmark. We added significant alpha in terms of stock selection, which is really what we're all about. And considering it was a market suited to value managers where oil did over 40%, almost 50% for the year, our outperformance is really very satisfying considering a market not suited to a quality at a reasonable price manager. Positioning for the year ahead, we're currently at about 66% in equity, quite a lot of fixed income in the fund, still holding that gold position and quite a bit of cash. We think that we're probably going to reduce equity exposure somewhat more as the discount to intrinsic value on our buy list is diminishing as markets have rocketed in the last number of weeks.